The largest and most profitable bank, HDFC Bank, reported a stellar performance with net profit increasing by 18% on a year-on-year basis in Q2 FY21 amid the dismal industry scenario. In our Ideas for Profit today, I'll discuss if the resilient performance in COVID times will actually drive valuation re-rating going forward. Well, HDFC Bank reported total advances of 10.38 lakh crore rupees as at the end of March, an increase of 16% that is over the last year, which is led by wholesale advances which increased by 27% on a year-on-year basis, while the retail loan growth moderated to 5% as well. Now, within the retail space, auto loans saw degrowth, while the gold loans actually increased by 13% year-on-year. Now, growth in deposits was robust at 20% year-on-year. Within the deposits, the growth in the low-cost current and savings accounts, that's CASA deposits, at 28% year-on-year, was much higher than that of the time deposits, which actually increased by 16% year-on-year. Now, consequently, CASA ratio also improved to 41.6%. The net interest margin compressed by 10 basis points, that is, when you compare it to the previous quarter, to 4.1%. Now, the bank also maintained high liquidity coverage of, say, 153%, which adversely impacted the margins this time. Now, the other income in Q2 was supported by the investment gains this time around. The core fee income rebounded sharply as compared to Q1 FY21, highlighting that the business is returning to normalcy. Also, with the business activity really picking up, operating expenses also jumped 17%, and that's on a sequential basis when you compare with Q1. Now, despite the increase, the core cost to income ratio stood at a very healthy level of 36.8% in Q2. Now, bank's digital initiatives, along with the focus on the low-cost distribution network of Common Service Center, the CSCs, in rural and semi-urban areas, seems to have really helped in controlling the growth in the operating expenses. Now, reported gross NPA was lower at 1.08%, mainly due to Supreme Court stay on the NPA tagging, without which GNPA would still have been flattish at, say, 1.37% as at the end of September. Now, the lender also created COVID-19 related contingent provision of 2,300 crore rupees in Q2. Consequently, the bank now carries contingent provisions of 0.75% of loans. Now, bank's total provision coverage ratio stands at 195% of the reported GNPAs and 154% of the pro forma NPAs. Now, this provides a lot of comfort. Also, HDFC Bank's efficient use of the capital is highlighted by the fact that the internal accruals are sufficient to support its asset growth. In FY20, the bank had generated 250 basis points and consumed only 110 basis points of capital. With such strong internal capital generation, the bank does not see any need of even equity capital raise at this point. Now, HDB Financial Services, which is a subsidiary of the bank, that reported a subdued performance in Q2 with steep decline in profits. Now, while HDFC Bank's operations are impacted, COVID-19 outbreak does not really permanently impair the bank's long-term earning potential at this point in time. HDFC Bank's valuation also has fallen, with the long-term growth and profitability outlook very strong. Now, this implies that the street is extrapolating temporary blip as a long-term concern, which at this point in time, Moneycontrol research thinks that this is unreasonable and presents an opportunity, in fact. Now, Mr. Aditya Puri, the CEO of HDFC Bank, who has led the bank since inception 26 years ago, is set to retire this month. And the uncertainty related to the management change and also the bank's high share of unsecured loans, around 17%, is something that everybody is watching of the total loan book, which is higher than most of the peers, and that has weighed on the stock's past performance as well. Now, with clarity emerging on both of these accounts, the overhang on the stock should really end and the valuation will get re-rated at this point in time. HDFC Bank's retail portfolio is also exhibiting better asset quality trends. Also, since the successor to the CEO is from within, the bank will now ensure continuity in business strategy as well. Now, at the current market price of, say, 1199 rupees, HDFC Bank is trading at 3.2 times its core book value estimated for FY22, assuming a very conservative earnings growth of, say, 10% on a CAGR basis over the next 2 years. Now, this is at a significant discount below its historical long-term average valuation multiple as well. Now, given the return on assets of 1.9 to 2% and ROE of around 16 to 19%, the valuation can revert to its historical mean levels, which actually, along with the earnings growth, can translate to reasonably good upside in the medium term as well. Now, given the stellar performance, and the high probability of the valuation getting re-rated as well, going on from here, HDFC Bank seems like a must buy stock and could actually form part of every investor's core portfolio as well.